So this presentation is on budgeting principles and CPA analysis, which is part of the NDC Action Project. The table illustrates the information requested by Green Climate Fund and Mitigation Action Facilities, which is to show generally donors like, for example, GCF who require you or the agency applying for funding to provide information on the total budget, requested amount, co-finance, and source of financial instruments to be used. Financial instruments that can be used for financing can be grants, which are essentially non-repayable funds provided to support the project, loans, funding that have to be returned with an interest rate, and other instruments like equity instruments, guarantees, etc. Activities related to capacity building, policy and regulation support, institutional strengthening, etc., which might have big transformational impacts but are smaller investments in monetary terms and are more likely to be financed by instruments like grants. And this can be estimated based on the assumptions on time needed to develop such capacities, policies, etc., and other aspects like need for external consultants and their fees, and among other things. Uh, there are other activities which might need more finance, and this could be instru- uh, investments and implementation of technologies. And this are more likely to be financed by instruments such as loans, guarantees, equity, etc., and often involve largest share of the total project cost. These need to be estimated based on the business case itself, along with a mapping of costs and benefits and analysis of the required support in order to make the investment viable. And this is also the focus of this presentation. Providing this information, building up your business case, and through a cost benefit analysis approach, comparing various options will assist you in structuring the arguments and justification for the donor support and why it is needed to ensure the viability and bankability of your project. It will also assist you in providing a justification for the amount and level of concessionality of funding requested and the financial instruments proposed in order to close the funding gap. In the case of grant funding, without a repayment contingency, you should present a convincing financial and or economic argument so that the level of concessionality should correspond to the level of proposal's expected performance against the investment criteria. So what is cost benefit analysis? Cost benefit analysis is a systematic approach to estimating the strengths and weaknesses of alternatives used to determine options that provide the best approach to achieve benefits while perceiving savings. It is a method used in both public and private sector to evaluate potential outcomes of a decision, project, or a policy. The goal of CBA is to determine if the benefits of a decision or actions outweigh its cost and by how much relative to the other alternatives. For example, US Securities and Exchange Commission has to conduct a cost benefit analysis before instituting regulations or any deregulation. It can be said that cost benefit analysis, or CBA like it is called, is related to cost effective analysis, which is also part of donor investment criteria. Benefits and cost in CBA are expressed in monetary terms and are adjusted for time value of money. I will talk more about the time value of money and discount rates later in the presentation. On its face value, CBA looks very simple, but can be complicated in process depending upon the extent of analysis that you are required to do. Let's look at the simple aspect of CBA first. It usually consists of four steps. Step 1, brainstorm cost and benefits. Here, all costs associated with the projects, imaginable and unimaginable, need to be identified and in the form of a list. We need to consider the lifetime of the project, when the costs and benefits are likely to occur. Step 2, you need to assign monetary value to the costs. Cost of physical resources and human efforts involved in all phases of the project need to be identified, and you need to then assign cost to all of it. This includes all costs incurred over the lifetime of the project and possibly the costs after the project's lifetime also. Step 3 is to assign monetary values to the benefits. This can be more complicated because everything is in the future and cost and investments are upfront. Benefits in the value of services rendered, direct and indirect costs saved, time saved, value of uh, pollution eliminated in terms of health benefits, benefits after the project's lifetime, etc., need to be identified and sometimes can be a bit complicated. Step 4 is to compare costs and benefits. Now, looking at the more complicated aspects, when we think about cost, basically, where do we draw the line about what costs to we incorporate in our analysis? As an example, in the case of mangrove protection, do we assess the cost of livestock not being able to graze mangroves if more surveillance and enforcements are introduced to prevent mangrove degradation? What about costs related to biodiversity loss if land is cleared for PV plants? Or cost of farmers downstream if we build a water catchment infrastructure upstream? The same goes when we are looking at benefits. We know there are air quality benefits of solar PV compared to other sources, but can we monetize it? What is the value of human health or of a species or a mangrove nursery? In addition, there is the whole aspect of time value of money. Basically, $1 in hand today is worth more than $1 in hand tomorrow. Discount rates dictate the future value of money. Discount rates are set to reflect the human perception of the future value of money, but are at the same time a theoretical construct. The graph here shows the different value of money depending upon the different discount rates. So basically, the choice of discount rates usually set up by the Ministry of Finance has a huge impact on the perception of viability and value of different instruments. In simple terms, high discount rate values a high short-term perspective and a quick return. This usually disfavors technology with long lifespans and low operating cost. Like solar compared to diesel generators. It usually disfavors projects with long-lasting positive benefits in the long run. There are discussions in some countries and fields about need to change towards applying different discount rates depending upon the level of sustainability of the intervention. So now that we have understood the principles of cost benefit analysis, we can try to structure the information on costs and benefits into a business case. In order to say something about the cost of activities, you first need to create an overview of the costs related to the introduction of the intended activities or practice. But keep in mind that the introduction of intended technology or practices create return or savings. The climate finance facility will not be willing to cover all costs of investments. You should try to incorporate revenues in your calculations and only seek the minimum amount of support needed to make the activities viable. In addition, since climate finance facility is willing to invest in activities that become self-sustainable over the time, it is a good idea to illustrate how the intervention will be financially sustainable in the long run. To do this, it is a good idea to prepare a business case. In order to build a business case, it is helpful to think of activities in terms of blocks of time, that is development phase, construction, pre-operation phase, and operation and maintenance phase. In each phase, different activities are carried out which should be identified, and in their turn, that example, using a logical framework approach or a theoretic theory of change framework, which once we are clear about the activities, the next step is to estimate the cost and revenues of each activity that need to be obtained, divided into phases. Project developers should go through each activity until ev- every one of the cost and revenue savings are identified. Once this has been done, the cost and the revenues have to be distributed over chronological time. This should be done both for the baseline, in other words, based on the current financial environment, such as loans and interest at the market rate, or the concessional finance you can access currently, but might have some limitations. For instance, Central Bank of Sudan has a microfinance guarantee agency. Could this be used to leverage additional finance for small loans to finance agriculture and mangrove restoration practices? Could other national agencies or programs provide parts of finance, even though not able to cover the whole investment? It is very important to note that showing even a limited potential co-finance from other sources will greatly improve the standing of your proposal. Having more financiers on board only means that risk is shared and that others already believe in your project. This is the easiest way to leverage additional finance and attract financiers. Of course, this is a chicken and egg problem, but important to keep in mind, and an example of where a small contribution from the national government also can assist in going far in leveraging additional funds. So, for the digression, next step is to consider the concessional finance you are applying for in the project, or the financial or economic enabling environment that will be created with the project, being loans, grants, creation of removals of subsidies, or disincentives, etc. What your analysis ideally will show is the BAU financial situation has some inherent barriers that prevent the investment from happening, while alternative support scenario is actually a successful one. The information needs, of course, to be generated using assumptions regarding the current and the potential interest rates on debt, loan conditions, discount rates, and tax rates to develop base case for financial plan. Are we all clear on these terms? Using financial calculator, we can then calculate various financial ratios such as net present value, internal rate of return, and payback time. NPV is an expression of time value of money, meaning that the current cash flows have more value than the future cash flows, and where the current value of future cash flows is discounted based on a chosen discount rate. NPV is a metric used to estimate the profitability of the investment. Of course, the discount rates vary country by country and type of the investment. IRR is calculated by reducing the discount rate of the net present value of all cash flows for a particular project to zero. IRR provides the metrics used to estimate the profitability of the projects, while IRR says something about the return on the investment, that is, how much money you will get back per dollar spent. NPV says something about total value of the investment, given an understanding of the size of the investment. Payback time says something about time it will take until the project starts creating revenues. Payback time is important to some investors and the choice of financial instruments. For example, an investor might not be willing to invest in equity in projects that have payback time far into the future, as this would mean they would bind the money that could have potentially be invested in other activities for a longer time. In this case, a loan might be more interesting as some funds will start flowing back early in the process. Net present value should be positive. Uh, a DSCR, which is a debt service coverage ratio, indicates cash availability to pay back the debts. This should be above 1. Internal rate of return should be positive and above the discount rate. The most common ratio used for a project appraisal by a funding entity is IRR. Among the rules of thumb used to interpreting IRR are: if the IRR is negative, revenues and the existing grants cannot cover the capital and operating costs for the project. Without additional revenues, grant or subsidies, the project proposal is probably not financially viable. If IRR is positive but below the discount rate, the proposal is financially self-sustaining but may be of limited interest to private sector as it does not generate a profit. Specialized impact lenders, investors and donors who value development, environmental and market transformational impacts may be prepared to consider such a proposal. If IRR is positive and just above or equal to the discount rate, the proposal's financial details, especially tax implication, debt structure, and additional revenues, need to be developed further, and a different financial scheme can be considered. The results may not be of interest to the private sector. Specialized lenders, investors, donors who are interested in blended investment are likely to be the target. If IRR is substantially above the discount rate, example at 10%, the financial details need to be developed with a strong view towards engaging private sector investment and lenders. In this case, which is shown on the slide, the IRR and the NPV are negative, which means that the project is not bankable under the commercial conditions. This is also a typical case where the upfront costs are high and the revenues are low because of fair regulations, etc. But in any case, the project moved forward, and this was mainly because there are substantial social and environmental benefits from the project. In this case, the IRR and NPV are negative, but the project is not bankable under commercial conditions. But again, the project moved forward because, as other project, it has social benefits and other benefits, other environmental benefits. In the case of adaptation, sometimes the financial analysis is not so simple and cannot be quantified in monetary terms right away. We can try to show this by an example. Here we are looking at a case where a farmer with a good yield in terms of kgs produced per hectare over a period of 10 years. So we compare the revenue from the yearly yield, which starts from the first year itself, with cost. The costs include maintenance, plot renting costs, cost for seeds, fertilizer, hiring of equipments, labor, and other costs. The yearly gross margin, that is the profit, is 523 US dollars. So if we consider the discount rate of 15%, the NPV, that is the difference between the present value of the cash inflows and present value of the cash outflows over a period of time, that is 10 years here, and after discounting for the time value, is 2625 US dollars, which makes the farmer happy. In another case, which we call an unhappy farmer case, the cost structure remains the same, but the yield is lower per hectare. Therefore, the revenue is less. This results in an NPV of 472 at the discount rate of 15%, making the farmer unhappy as the present value of the cash flows is substantially less. In the adaptation case, we find out that the unhappy farmer has lower yield as enough water is not available. So in the adaptation case, upfront investment is made in water storage so that the yield of the unhappy farmer increases. So all parameters remaining same, we find out that by making the upfront investment of around 106 USD in water storage infrastructure, the yield substantially increases and the new NPV is 1553, which should make the unhappy farmer relatively happier. The base case provides a picture of the project and potentially an argument for why concessional finance is needed. And the alternative case provides a positive picture of the project when the needed enabling and financial environment is created, allowing for investments to happen. Although both equity investors and funding institutes that provide grants and loans will always require an understanding of the risk of the investment. We will touch upon this topic in some other presentations later on. But in terms of financial risk, it's important to understand how changes to financial structuring, such as grants from donors, loans from lenders, and equity from owner investors, will affect the project. So, an analysis of what could happen under different circumstances or if our assumptions changes during the implementation is required. The parameters that you want to test, uh, the alternatives might depend on specific situations. Example, in countries with high currency fluctuations, changes to the value of dollar versus local currency might have a huge impact on the financial performance of the project. If the investor provides a loan in dollars, this might also help you to identify the potential risk prevention measures like currency exchange guarantees. Other parameters to check might be lower revenues than expected, higher construction and owning and management cost or owning and operating cost. Other powerful instruments like government guarantees in case of project. Other powerful instruments are government guarantees in case the project underperforms. The outcome of this analysis are alternative IRR and NPV, two different variables. Keep in mind that even if the project is robust under different kinds of stress, it might be relevant to also combine different scenarios in order to identify worst case scenarios, as even small variations in variables when combined can make the project unviable. And thank you for your attention. I am Talat Munshi and I am a senior advisor at UNEP Copenhagen Climate Center.